it's important to realize that there is quite a big zeitgeist shift underway right now. You can see that perhaps most clearly, not just in terms of the behavior of bond yields, nominal bond yields, but if you look at inflation-linked bonds in particular, they have been performing very well because investors have been buying them to hedge their portfolio. Now, on the face of it, that might seem absolutely peculiar because we've just had the consumer price data come out this week, which shows that inflation pressures in December were incredibly muted, and there's very little wage growth. The level of economic growth is pretty weak too because of the pandemic. But there are really three key factors which are causing investors right now to think about inflation. The first is a chance that if you do have a big fiscal stimulus package from Joe Biden's incoming administration, and if that coincides with the pandemic vaccine gradually spreading across the country and reducing the pandemic fears, you could have those two factors coming together and create quite a big upsurge in growth later this year, which could coincide with supply chain bottlenecks because so much capacity has been knocked out by the pandemic. So what you could see is that prices, say for hotels or travel or leisure, suddenly jump up in a way that will skew the inflation data. Esther George, head of the Kansas Fed, spoke about this just this week. The second issue, which is equally important, is that many of the structural factors which have kept prices low in recent decades, most notably globalization and digitization, might be, if not reversed, but become less forceful in the decades ahead because, say, the demographics in China are changing. That's a much bigger debate, but it's very important to take note of that. The third issue, though, the really important issue, is the Fed. And investors' assumptions of ultra-low inflation in recent years have been partly based around this idea that the Fed's 2% price target meant it would jump in and nip inflation pressures in the bud if they started to emerge. What's changed, though, are two things. Firstly, Fed officials are saying that 2% is now an average target, not a ceiling, which means that they might be willing to let inflation rise above 2% for quite a long time. Secondly, there's an appreciation that the political economy pressures in the years ahead could make it incredibly hard for the Fed to act preemptively. In particular, as the debt burden explodes, it's going to be so hard for the Fed to do something which is going to raise the debt servicing costs in the future. So that, in plain English, means the Fed may sit on its hands, which also means inflation could well be more of a risk than investors realize.
And in part, could it be that the Fed wants to sit on its hands in this sense? Inflation, as you say, is relatively modest. At the same time, negative real yields, that is to say, the difference between the inflation rate and the zero, effectively zero interest rates, really have record negative real yields. Might that be actually a strategy to actually inflate our way in part out of that debt problem you just talked about?
There's certainly a temptation for the Fed to sit on its hands in terms of running the economy hot and helping growth. Helping, it should also be said, in the eyes of some Fed officials, low-income communities as well. You know, the idea is you have a large amount of growth, then that will gently trickle down to poorer people. For what it's worth, I personally think that's a huge mistake because I think what the Fed's doing is inflating the value of the assets that the rich hold and increasing income inequality. But in terms of trying to inflate yourself way out of a debt burden, yes, absolutely, there's a school of thinking in the investment community and the economics community that says that's probably the only way they're going to get out of that debt burden. The danger, though, is that if you do have inflation starting to come back as a significant threat and a perception that the Fed is not willing to act, you may then also see overseas investors start to become more nervous about holding US treasuries. And the problem with America is that at the end of the day, it is dependent on the kindness of strangers or the willingness of foreign investors to keep funding this exploding debt burden that the incoming administration is going to face.
Gillian, I think there are a lot of investors right now, even as we speak, who are asking themselves, okay, what do I do about this? How do I protect myself against the possibility of inflation kicking in a way that's unexpected in a world where basically the risk premium are almost zero? I mean, basically I'm getting no return at all. What does that mean as a practical matter? Historically, does that mean you go into real estate? Does it mean you're better off in commodities? What does that say to your investment strategy?
Well, I'm not going to sit there and make detailed indications about what exactly investors can do to construct their portfolio. But perhaps what they really need to do is recognize that although significant inflation, in my view, is probably still a pretty low risk probability or low probability event, if it does come back, it could have a high impact. It's not quite a black swan because people are talking about it, to use Nassim Taleb's metaphor. But it's a grayish swan, if you like, something which we can imagine and would be high impact, even if it's low probability. And buying inflation-linked bonds is certainly one route that you can use to try and protect against that. And it's exactly what people have been doing. Inflation-linked bonds, by the way, on a risk-adjusted basis, were arguably the best performing asset class for 2020.